All right. Good morning, everybody. We made it to Friday. So it turned out with all the bricks in the wall of worry that Amazon gave us the biggest shock to the system. And of course, the tariff deadlines with August 7 now in focus. We got Hong Kong down 0.25%, but we got red on the screen around the world. Europe's down 0.5%. Japan's down 0.75%. The Dow more than 0.75%. S&P close to 1%. NASDAQ at 1%. And small caps lead the way at more than 1.25% to the downside. We're going to get some job numbers today. Some manufacturing numbers, construction, and of course, now that FOMC has passed, we're going to start hearing from various Fed members again, along with auto sales. Like Ford and GM didn't get hit enough. We're going to pile on a little bit more. This is the non-farm payrolls. It's the job numbers that everybody focuses on. And we can see the number moving from 147 to 110. It's not extreme, but the concern is that the consensus is wrong. And then, of course, there's going to be revision numbers. So watch the clock at 8:30. We have the potential for a liquidity gap setup. It's a really nice trade I've covered multiple times. At the bare minimum, even if you don't want to trade it, you can use the setup for analysis to define the rest of the trading day. So after that, we've got 10 a.m. The 10 a.m. data affects the phrase, if we haven't broke out by 10 a.m., we likely won't break out until after lunch. That's a real deal, and I lean on it a lot, but you can't lean on it on days where we're going to get data at 10 a.m. because it kind of negates the whole idea, right? If we're going to get data at 10 and it's expected to be big data, we'll go sideways and not break out until 10 till we get the data, and then we break out, right? It also doesn't work well on Wednesdays because, well, we get oil at 10:30 and that can mess us up, right? So I would not look to use that phrase today. And if you haven't heard that before, well, then just write it down and tuck it away somewhere. Go back in the past and validate how many times you can find that to be true. It's a lot. And then that gets us into the weekend. So really, the worst of everything is going to be done before lunch. And after that, it'll just be any news that happens to hit headlines. Keep your eye on Europe and the European close today. A lot of times I've noticed if the US markets are impacted by European headlines, then after the EU closes, whatever was happening to us can flip. So if they drove us to the upside, we can get one of those rounding tops and start to fade intraday. Or if they beat us down, then we can sort of get a cup and handle look, or even something a little sharper like a V bottom and come back up on the day after Europe closes. If you don't know when Europe closes, there's a really great website and it's free. It's called tradinghours.com, and it has all the trading brokerages from around the world and whether or not they're open, and it checks their time zones and it checks their calendar to make sure that they actually did open and that they're not on some sort of holiday close or, a bank schedule or some other reason that they're not open. Because just like US markets, markets around the world close for various holidays and various reasons. So it's a great website. If you have never gone there, check it out. Doesn't cost you anything. We are in a new month, so we're going to be doing the door levels Monday or Tuesday. It's DOOR, day one, open range. It's an open range concept used on a daily chart rather than an intraday chart. So we got the dollar back above 100. It's kind of going in the wrong direction in consideration with what the administration wants. 10 years still holding below that 4.45 level, which is way up here, kind of the line in the sand. And of course, the ES got down into that 6,300. The put and call wall didn't get rolled. So I was looking at those numbers this morning. We're underneath the put wall. Zero gamma and volatility trigger. At this point, with it being so late in the move and the start of the new month, it's possible that we don't see them mess around with these options too much. So how we close today will be important when we come in next week. And you can watch these levels to see if they start to really do anything with the options at those strikes. But it's really going to be more after the open, say, probably around 11 o'clock, maybe noon, in the SPX, not the ES, because these options trade all night. They can be trading on them right now for all we know. But for SPY, SPX, we got to get into the open and then see them monetize the put wall and see how the dealers are going to deal with being in a negative gamma environment. Monitoring that zero gamma level for all the expirations is different than looking at it for one expiration. Looking at the moving averages, 6190 is where the 10-week is at, and the 10-week is considered the mean. And until we get below the mean, the long-term trend is still intact. So we would need to break and close below that 6190 cog line and 10-week moving average to even consider the idea that we're in a bearish market backdrop. We're nowhere near that level. Now on the daily, we have something called a surge signal. It's a bearish surge. First, price breaks through the 3 and the 10, and then the 3 crosses the 10, and that's what we have here. So with price now under the 3 and the 10 and the 3 under the 10, we have a bearish surge, and we're focused on the 20 now, which is the green line, and price is already below that. We want to see if the 3 period gets below the 20, and then if the 10 can follow it and also get below the 20, then we would have bearish momentum to go with our bearish surge. we don't have an established low yet. Like back here, price dropped down, gave us a low, left that low behind, and then ran upwards. That's what makes it established as a low. At this point, all we've done is wicked up a little bit, and today's not closed. So we don't know if this is the low or just another low, like yesterday was just another low. We don't know if we're still falling or if we're going to bounce yet. And we won't know if it's a bounce until we look back and say, yep, that was a low. And we now have a higher low. That's the way it works, right? You can't anticipate ahead of time if that's going to be the low or if we're just going to keep falling. After we set a low, whenever we do set it, whether it's going to be this one or later, we have to run up off of that low and then determine if we're going to get a lower high or if we'll run all the way up and set a higher high. And again, we won't know about that until we run up and do it. There's no anticipation beforehand on trying to determine if we're going to get a higher high or a lower high. Now that we're underneath the 10-day moving average, it is the line in the sand that we have to get back above. But the 20-day moving average is sitting on top of the put wall. So now that's 2 levels of resistance. It's also 63.32 cog line. That's 3 levels of resistance. It's also last week's open, and it's the previous week's close. That's 5 levels of resistance. And this week's high at 6 levels of resistance. And this week's high at 7 levels of resistance. You get the idea, right? 63.32 is now this massive critical line in the sand with a lot of resistance sitting right over our head. It was resistance before. We fought it to get through there on the way up, right? We hit it and stalled, and then we finally made it through. Well, now we broke back down below, and we're going to have to do the whole thing all over again. Those are weekly candles, so those are significant levels. If we do get back inside of last week's range, which at this point it's not very far away, we could do that. Then we need to focus on last week's midpoint, 63.75. If we close below last week's midpoint at this point today, when we get into trading next week, then the current week's midpoint is going to be the line in the sand that we're going to want to focus on. We'll get into it next week, I reckon. We got elevated volume this morning, which, that generally happens when we get a down move. So we're looking at twice the amount of volume that we had yesterday and nearly, 3 or 4 times the volume we had on any other day this week. So a lot of volume, 160,000 in the overnight. They got a lot of work done, and we can see it in the price action and in the total overnight volume that was traded. So when we look at that, we ask, well, what do they have left to do? They already got all their work done. maybe they got a lot of work done, but we don't know if they got all of their work done. They could easily come in and, double this again. That was a nice play against the 10 for anybody who was trading last night, but we cut through that 20 like it wasn't even there. I am watching for VWAP reciprocation this morning. How far we got underneath the VWAP, we could get back above VWAP, just looking at what I call that zipper play. But first, we've got to deal with non-farm payrolls and the potential for a liquidity gap. We have a market maker move this morning. They are hedging in front of non-farm payrolls. They're worried and they're spending money to buy additional insurance. And we hit the ADR early enough that we could go to the other side by the end of the day, except there's a little bit of a hiccup. When we use that phrase, it's usually if we get to the half. And then we can say we think we can get to the other half by the end of the day. But we didn't just get to the half. We got all the way to the full ADR. And then we pulled back like we were going to leave it, and we went right back to it, and we went through it. So now the concern is that we can't even get back to the half, let alone to the other side of the half. Today, at least, it wouldn't matter if we were using the 5 o'clock close or the 6 o'clock open, because they're lined up about the same. But it will matter for the SPX and the SPY, right? Because when we open at 9:30, that's when they are going to get their ADRs, and their ADR levels are going to be completely different. They'll be based on where we open at 9:30. So if we open down at like 6,300 at 9:30, and then the SPY gets its ranges, it'll be completely different. The market maker move gets applied to these ADR ranges. So the ADR was 55, and then we got another 40 points with the current market maker move. That would be 95 points from where we opened at 6 o'clock. Let's just round up and call it an easy 100, right? Just for some easy math. So if we mark the daily, 63.68 is where we closed last night. And we take 100 points off of that at 62.68. That's what the market maker move says we could do today without even getting outstretched, right? We think about overbought or oversold or having moved too far, too fast. This says we could go that far and it wouldn't even be out of line. That if we're looking for one of those big wow blowout days and having moved it too far, that we would have to go even farther than that to even begin to consider being overbought or oversold. Going that far, just another day in the park. Probably won't feel like it though. Since more than half the trading day is done already, moving that far would feel a bit extreme. And if you're thinking that this is either or, you're missing the point. We can get to both of those levels by the end of today. Sounds kind of wild, doesn't it, to think that we could go from 62.68 to 64.68 in the same day, but we can. We've done it before and we can do it again. The idea being from where we opened last night, we can run down and hit one side, run all the way back up and hit the other side. We've even seen it where we went down, tagged, went up, tagged, went back down, and tagged again, all in the same day. Good times on the S&P, right? So at this point, what it owes us is a trip back to the other side, the red line half, 63.87. But if we can't get through that 63.32 cog line that I was talking about with 8 levels of resistance spanning from the monthly, the weekly, the daily, the cog lines, point of control, and everything else that's piled up on that 63.32 cog line, if we can't get through there, then we can drop back down, break this low, and get all the way down into 62.80 area. And that would just be a walk in the park. If we get ugly today, we could get to 61. We could get to 60.50 by the end of the day. No reason to expect it to get that extreme, by the way, right? Just because price could do that doesn't mean it's going to do that. All it would take is one headline and we'd be sitting back up here at 64.70. Keep your eye on the market maker move after 8:30. We have to make an assumption that this market maker move signal is because of non-farm payrolls. And it's a pretty solid assumption, all things considered, but it's still an assumption. And you know what they say about assuming things. So while I'm pretty convicted that it's because of non-farm payrolls, what if it's not? What if it's because of something else? So after 8:30, this number should begin to decrease. If it doesn't, then we know that they're worried about something else that may come out today. The 10 o'clock data, for an example. At the end of the day, it's going to be at 0 anyways, so it will disappear at some point through the day. These are 0-day options, and that means their life is almost over. So it will go away. But we want to see it begin to decrease after 8:30, and that would tell us that they were hedging non-farm payrolls specifically and not something else. Yesterday, we had the discussion about the ADR lines and how we could go from one side to the other side by the end of the day, and it wouldn't even be a bearish bias, right? Because that's just the way markets move. This isn't one of those I told you so's. It's more of just get used to the way price moves, right? It's a wave, just higher highs and higher lows or lower highs and lower lows. It's pretty basic. That's all we're doing at this point. We're just setting these lower lows and lower highs. But we haven't given up this strong bullish backdrop that the market has. And I wouldn't load up on a bunch of shorts. Nothing wrong with some hedging. That's just being prudent. But, I wouldn't get all bared up and try to smash this market to the downside. Not yet. We don't have those kind of signals. We are underneath the weekly floor pivot, and we're through the weekly channel. Today's daily floor pivot opened lower than yesterday's. That's bearish. Price opened underneath that pivot, and that's also bearish. We tried to make a run for it and missed, and then expanded away from it. And it's a wide channel, which implies if we break out, that the breakout doesn't stick. Well, we already broke out, and so far, it's sticking. Let's focus on SNR levels at this point. So we've passed S1 and we're close to S2. And since yesterday was such a big move, S3 is way down here. But that 6287 sounds familiar. We were talking about that earlier with the measured move on top of the ADR, right? That was the same level. So that's 2 levels of support at 6287 and a reason to believe that if we continue to the downside, that it would be our flipping point. We'll see. So after getting definitely an S1, maybe an S2, we could get to this floor pivot. It's not out of line, but to get there, we've got to get through 63.92 cog line, which is the weekly floor pivot, and then the round number 6,400, which is basically today's floor pivot. That would put us back inside of yesterday's trading range. The concern is that we're going to fail against that 63.32 and not be able to get back above S1. If we don't get it back above S1, it does put S3 on the table. Because then we would be talking more about that wave. We got stacked points of control back here from the first 2 weeks. Well, I guess it was the second and third week of July. This point of control from the 6,300 area, plus 6,300 is an options level, and we're getting a little structure here. If that breaks, we've got 6,250 and then 6,150. We'll start moving in 100 chunk drops after that. 62.5 to 61.5, and then 60.5, 59.5. You get the idea. But again, there's no reason to think it's going to get that ugly today, but it could. And that's the main thing that you want to focus on, is that it could. I would be looking to play the reversal at this point and try to run it back up simply because it's an LRE. Low risk entry. You have less risk trying to buy this low and run it back up than you do trying to short from this low and continue the drop. But just run a 786 and that'll be your guidance. Well, so much for getting a narrow 10-day volume profile. Talked about yesterday how we could wipe some more of these candles off the left and end up shrinking this profile into something about that size. But now we dropped back down here, which I mentioned yesterday was possible. And so we're not going to see the volume profiles range shrink anytime soon. We could see the value area tighten up as we wipe these candles off, simply because we moved through this zone really fast and these candles didn't leave much of a footprint behind. But we can still see a footprint simply by the candles that were already here. So as we take Friday and Monday off the table, maybe Tuesday, we'll take those candles off, and this volume that's down here will be much less, unless what we're doing this morning winds up a little higher and we spend the day chopping. We can see a little bit of work getting put in here, right? Those belong to that. We can see it better once we drop down into this time frame. That VPOC from yesterday was already hit, so we'll just take that line. $64.46 is yesterday's point of control. The textbooks will tell you to mark this value area low and the value area high. Normally, I wouldn't carry forward that value area, but I'm going to do it just for today, simply because if we do get a break to the upside, I think that level's going to come into play. You can see the work that they're putting in this morning. We had a lot of work last night, so there's one distribution and then another footprint here, and that's where the point of control is. The TPO, however, still has the point of control way up here. So we want to see that drop down. That way they match and they're in sync. And we've got a VPOC at 62.83. If we continue to the downside, we could get a first touch play down here. That might be where we finally get our reversal as well. So if we break that 92 cog line low, see if we can turn around off that VPOC line. And we have expanded below the week's range. Now, we're supposed to close inside this box 70% of the time, but we've been failing to do that for a while. And it doesn't mean that the indicator is broken. It just means the market makers aren't doing a very fair job of pricing in volatility. So it's more of a risk headline than anything else. When we see this breaking the range and closing outside of it on a weekly basis, then we start counting them up as another signal of risk. So we had one back here. Nah, scratch that. That's a 4-day week. I don't use 4-day weeks. We had one back here. That's a 5-day week. We closed on the line last week, which is why we talk about building butterflies there. You'll lose like 8 out of 10 of those butterflies, but they're really cheap. You know, like 10-cent losses and 5-cent losses on the SPX. So you'll lose, 8 times in a row, and then you'll hit one winner, and it'll cover all those losses and put you up on the year by a significant amount, right? When you can build, a $10 wide butterfly, and when you're wrong, you lose $5, but when you nail it right on the money like that, and you can make, $900, they pay for themselves. The weekly expected move indicator is really good for that. But if we go back and count the last 10 weeks, if we find that we closed outside of the box more than 3, then we're not getting our 70%, right? This is one of those weeks so far. The week isn't done. We don't know if we're going to close outside the box or not. But this was one of those weeks back here. And like I said, I don't count holiday weeks where it's a short week. That one was on the line. That would have been another butterfly hit. I was listening to a JP Morgan. I think it was JP Morgan. Maybe it was Goldman Sachs. But I was listening to this trader from one of the big firms, and he was kind of poo-pooing on butterflies. And he said in his 20-year career, he had never hit the bullseye on a butterfly. And I thought, well, you must be doing it wrong, bro, because I'm hitting like 20%. And I'm talking about bullseyes of 20%, not just having a profitable butterfly. Guess the dude should have just listened to the videos that I made on the weekly expected move, right? Because it's not that complicated. 20 years and he'd never hit the center of a butterfly. Obviously, he's doing something wrong. So we are below the 10-day. Anything less than 1% is fine. If we start to expand below 1%, then it can get to 2.5 pretty quick. What we don't want to see is some of this stuff, right? That's where we get really extreme and start looking for mean reversions and that sort of stuff. This isn't even close. So we haven't expanded far enough to look for any sort of mean reversion. It doesn't owe us some whiplash back in the other direction or anything like that. We're a little negative, but at this point, it's not extreme, and there's no, it doesn't owe us any sort of mean reversion. Now, looking at it on the weekly, we're still above the 10-week by 2%. And we are talking about yesterday how we haven't come back to the 10-week in a while, right? All the way back here since the start of the, well, when the administration capitulated, right? We had the April 2nd deadline, and then the bond market blew up, and on the 7th, he capitulated, and we flipped and we got back above the 10, and we've been keeping it since then. And we're still up there, but we are declining. So keep our eye on that 10-week, and whether or not we actually get back to it would be one thing. Getting below it would be the other thing. And I did mention yesterday that targeting the 10 would be a really nice short-term swing trade. So if you took me up on that offer, probably doing pretty good. If you didn't, look for a pop to the upside today and then try to put a short on for the 10. Don't do it while we're still falling. Don't buy puts when we're falling, right? For short-term trades, especially a day trade. We do have next week's range projected, but it's just a projection at this point, and it's continuing to move. It's not locked in place like these previous weeks. It won't lock until after 4 o'clock today. So you can keep an eye on it and see if it's, increasing or decreasing, but until after the close, it doesn't count. I just measured it and set it against our current week's range, and you can see that next week is much bigger. They are pricing in volatility for next week. Now, that's a little weird, right? Because all the scary stuff was this week. Why was this week's range so narrow? Is because when we have scary stuff like FOMC and QRA and that sort of thing, the markets actually anticipate going sideways into those events. So they are volatility suppressing. FOMC is volatility suppressing. So we had a projection this week of a narrow range. They're not projecting sideways next week. The whole hurry up and wait thing that I talk about, yeah, that's off the table. They're projecting that we're going to giddy up and go. So, while we've been playing the ranges and the 111 on yesterday's reversal and the 1236 and yesterday's reversal, that's off the table when we see an expanded range like this. If we get breakouts next week, you probably want to play the direction of the breakout. That's a rough estimate. We'll play it by ear when we get into things next week. But with the increase in the width of the range, it's a safe assumption at this point. We'll see how it closes because we will evaluate it again on Monday. Pretty much everything is down. I think it'd be easier just to look at what's up this morning than to look at what's down. So when it comes to what's up, we've got the Mag 7 down volume is up. I know that's a little weird, right? The down volume is elevated and the VIX is elevated. It's up 23.75% over a 5-day period, and 11.25 of that happened in the overnight. So it was already up 12%. It just moved another 11%, right? And that's all we've got that's up is down volume on the Mag 7 and the VIX. Now, TrendSpider says we got a little bit more than that. Retail's got this little algo print. May be hard to see in the live stream, but it's all the way up here. So we're at 79.83 from, 78.60. So big gap, but it's just an algo print. And until we actually start printing some candles up here, I won't believe it. Then we've got, you know, uh, high yield junk and gold. Well, nope, never mind. Gold's not up enough. It's moving in the right direction. It's just not there yet. So again, that's kind of an algo print. We want to see some candles fleshing that out. And it needs to get up to 0.5% anyways. So junk is up and retail-ish needs to put in some work. But that's a reflection more of staple anyways, right? We're getting away from the Mag 7 and looking at a flight to safety. Now, this is just the dust, the beginning of a flight to safety. We're not even really seeing anything because the market's not open yet. Once we get into the open, you really want to check for that flight to safety to start coming through. Use the ratios like XLY versus XLP. That's a really great flight to safety signal. And then, like your growth versus values, IWF to IWD is a common one. You can look at weighted versus unweighted in the S&P or in the NASDAQ. You can run both of those. Either way, the tools that we would use to evaluate if we're getting a flight to safety, they're not going to function in the pre-market, so that wouldn't do us any good. But that's a nice little early warning heads up that the one thing that's up this morning is retail. I guess it's better than nat gas and solar and pot stocks. Certainly don't want to rally on pot stocks. Looking at what's down the most, though, just for a consideration of how bad is it getting out there. China, 2%, Mag 7, 1.75, chips more than 1.5. China again, Bitcoin, 1.25. Building materials, industrials, utilities, financials, biotechnology, just about every single sector is down at least 0.5%. Some that are still kind of wishy-washy would be energy, nat gas, crude, which are all kind of the same thing. I hate to lump them together that way. And staples. For these ones that are showing zero, it just shows that they don't really have enough trading movement to register. It doesn't mean that they're not negative or that they're not positive, to be fair. They're just not getting anything yet. So we got to get those into the open. So it feels bad out there, but looking at the bigger picture, we don't have, big forces showing bearish sentiment yet. We got to get into the open and start to see this through. All right, so just sum it all up nice and neat. We got our box. That would be our Globex trading range. This is what you have to deal with. In 15 minutes, we're going to get non-farm payrolls, which is going to provide, very likely, a large candle, and you want to measure the entire candle. Let's just go back here and use this candle for an example. So at 8:30, we're going to get a really big candle, kind of like this. At 8:35, once that 5-minute candle closes, measure it from its high to its low, mark the mid, and then project 50% above and below. To get a little guidance on where price is headed. So after that 8:35 candle, if we're headed down, you'll have 1.5 as the next level. If we're headed up, you'll have 0.5 in that direction is the next level. That would be the first stopping point. Those liquidity gap bars are called a gap for a reason. We expect them to mean revert, go back to where they started. So if we continue to use this candle as our example, if it opened there and it closed way down here, we'll be looking for a mean reversion. We'll be looking for price to go back to where it came from. It might take a while. Usually takes, from 8:30 to 10:30, 10:45. So about 2.5 hours or so, 2.25. Closes by 11 usually. And we don't want one with big wicks. So if it's a bunch of big wicks and price closes near where it opened, well, I just said it, didn't I? It closed near where it opened. So there's not much of a gap to close. It will almost immediately close that gap. But even if we do get a big bar with big wicks, measure it from top to bottom and project the levels 50% above and below. And the mid, keep the midline on there. So this is our range. Once we're through non-farm payrolls, keep your eye on this range. If we break it to the downside, we can play the move lower. We got the levels that we've already talked about. Otherwise, look to run up, break the high, and challenge yesterday's levels. Yesterday's levels include its halfback. Start with the intraday halfback at 64.04, and then the full halfback 64.13. And for those who know, right now we're hitting that 786, right? This is setting up to be my failed flag play. We haven't failed yet, but it's setting up for one. And if you think about it, for anybody who hasn't gone through that material, if it's a bear flag, it's supposed to go lower, right? That's what bear flags do. If we call it a failed flag, that means it didn't go lower, right? It continued to go sideways, and then it ended up going higher, and that ends up forming a big old cup with maybe a handle and then maybe an extension. We don't know that yet, but it's starting. We'd look for a 786 as a breakover point and then run it back up. It's like a TRB, but bigger, right? So it's Friday, guys. Be careful, be safe, have a good weekend. Watch the clock. I'll see y'all next week.